All right, let's dive right into this explainer and translate the chaotic, totally jargon-filled secret language of Wall Street into a clear, usable playbook. Seriously, if you've ever stared at a financial news ticker and felt like you were trying to read an alien language, you are definitely not alone. But believe it or not, underneath all that crazy complex terminology, the market actually runs on basic principles that anyone can understand. So today we're tearing down those barriers so you can fully decode the market.
To make sense of it all, we've organized this massive dictionary into 5 key chapters: stock market foundations, financial instruments and funds, market movements and metrics, trading strategies and analysis, and finally, Wall Street slang and chaos. Let's get right into it.
Section 1, Stock Market Foundations, the absolute basics. Let's start right at square one to see how public companies actually operate. So, at its core, what actually is a stock? Well, it's a literal ownership. Each unit of a stock is called a share. If you own 50% of a company's shares, you quite literally own half of that real-world business as a shareholder. You aren't just buying some blinking ticker symbol on a screen, you're buying a physical piece of the pie. But here's the catch, right? You and I can't just stroll directly onto a stock exchange floor to buy those shares. We need a broker. Now, historically, this was a guy in a suit you'd call up on a telephone. But today, brokers are basically just online platforms that execute your trades for a small fee. They act as your essential, everyday bridge to the market. Now, you might be wondering, what if you don't want to pick just one individual company? Like, what if picking a single winner feels a little too risky, and you'd rather just own a tiny piece of everything? That brings us to Section 2, Financial Instruments and Funds. Let's see how our options expand way past just those basic single shares. You see, capital, which is really just a fancy word for money or anything holding value, doesn't only flow into stocks. It moves into entirely different asset classes. For instance, you have bonds, which is basically you playing the bank and handing a loan to a company or a government so you can earn interest. And then there are commodities. Just think of these as the physical raw materials of the world: grains, gold, beef, oil, and natural gas. So getting back to our question, how do you buy the entire market at once? Well, investors use vehicles like mutual funds or ETFs, which stands for exchange-traded funds. These are basically giant pools that gather money from tons of different people to buy a massive basket of stocks. Many of them are actually index funds, perfectly designed to just passively replicate the whole market, like the S&P 500. It's awesome because with just one single purchase, you instantly own a tiny, beautifully diversified sliver of hundreds of massive businesses. All right, Section 3, Market Movements and Metrics, Tracking Performance. Because once your money is actually in the market, it absolutely does not sit still. You've definitely heard these phrases thrown around on the news, but the visual imagery Wall Street uses is actually pretty wild when you think about it. A bull market means prices are rising, while a bear market means prices are falling. And they're named entirely after how these animals attack. Bulls aggressively thrust their horns upward into the air, while bears heavily swipe their massive paws downward. It makes perfect sense once you picture it. The underlying engine driving those animal markets is actually the oldest rule in the book. It's just the simple balance of supply and demand. Supply is the quantity of a good that's available, and demand is the quantity that people actually want. If demand is super high but supply is low, asset prices shoot up. If supply is huge and demand completely dries up, prices plummet. That fundamental push and pull dictates the daily volatility of every single stock out there. To figure out if a stock's price actually makes logical sense, analysts always check the PE, or price-to-earnings ratio. It's a tool to help determine if a stock is overvalued or if it's an undervalued bargain. But as an investor, you've got to be really careful here. A PE ratio relies heavily on past earnings, and a company that made massive profits last year could completely stumble and faceplant next year. So, with these specific metrics and trends in hand, how exactly are the pros making their moves? What are the actual practical mechanics of trying to beat the market? Let's unpack that in Section 4, Trading Strategies and Analysis, Securing a Profit. Let's look at the specific methods investors use to try and get an edge. Generally speaking, investors split into 2 distinct camps. First, you have value investing. These are the traders out there hunting for stocks, trading for less than their true intrinsic value. They are basically looking for underappreciated bargains. And then you have growth investing. These traders are taking elevated risks on young, explosive companies whose earnings are expected to absolutely skyrocket. It offers potentially massive returns, but obviously brings significantly more risk to your portfolio. Now, let's look at one of the most aggressive, stress-inducing maneuvers out there, shorting a stock. Here's exactly how this wild bet works. First, you borrow shares from a lender. Second, you instantly sell those borrowed shares at their current high price. Third, you sit back, wait for the company to fail and the price to drop so you can buy the shares back for super cheap. Finally, you return the shares to the lender and happily pocket the difference. But here's the totally terrifying part. This strategy comes with strictly unlimited risk. Since a stock's price can technically rise to infinity, you could be on the hook for massive, massive losses because you are legally forced to buy those shares back eventually. And when that unlimited risk actually bites, you get what's called a short squeeze. If a shorted stock's price unexpectedly goes way up, short sellers start to absolutely panic. To cut their mounting losses, they are forced to frantically buy the stock back to return it to their lenders. But guess what? All those investors suddenly buying the stock at the exact same time creates a massive wave of demand, which causes the price to skyrocket even further. It creates an absolute nightmare of a feedback loop for anyone betting against that company. Which brings us perfectly to Section 5, Wall Street slang and chaos. Welcome to the true Wild West of the market, where reasoned logic regularly takes a backseat to intense emotion, scams, and some very colorful internet slang. First up is the anatomy of the classic pump and dump. Guys, this is straight up illegal fraud. Here's how it goes. Operators quietly buy a stock for practically pennies. Then they artificially inflate the price by flooding the internet with false, incredibly positive statements. That's the pump part. Once the price spikes from the hype, they dump all their overvalued shares onto unsuspecting everyday investors. And the second they exit, the price predictably crashes and regular people lose all their money. To navigate modern trading, especially if you're hanging out in online forums, you really need to understand some of this weird slang. A black swan is a completely unforeseen, totally unexpected event that shakes the entire market. A dead cat bounce, which is honestly a pretty grim term, is a temporary, short-lived price recovery right in the middle of a massive decline. Whales are investors with capital so massive that their trades make literal waves in the market. And to the moon just means an asset's price is rising stratospherically fast. But listen, you've got to be incredibly careful if you're out there chasing those to-the-moon promises, especially inside penny stocks. These are shares valued at less than $5, and they are notorious for intense volatility, just whipping up and down aggressively. For the average investor, playing around with these is incredibly dangerous. When that kind of extreme volatility hits the broader market and prices really plummet, it triggers what's known as panic selling. This is a massive, widespread sell-off driven entirely by fear and overreaction rather than any actual reasoned analysis. The heavy selling drops the price, which causes even more fear, causing more selling. It becomes a psychological spiral so intense that stock exchanges sometimes have to literally hit a circuit breaker and halt all trading just to force everybody to take a deep breath. After learning all these complex terms, these highly risky strategies, and the intense market mechanics, it's honestly super humbling to look at the efficient market hypothesis. This economic theory basically argues that current share prices already perfectly reflect all available public information. Therefore, because absolutely everything is already priced in, it is mathematically impossible to consistently outsmart or beat the market over the long run. So the final provocative thought I want to leave you with today as we wrap up this explainer is this. If the efficient market hypothesis is actually right and beating the market consistently is truly an impossible task, why does the game never stop? Why do millions of us log in every single morning to try anyway? Thank you so much for exploring the mechanics of the market with me today. Keep learning, keep questioning, and I'll catch you in the next one.